the jobs revision report that came out. Not necessarily a good report for jobs, but would give us a little bit more confirmation that a rate cut in September is almost certain. I will not say certain, but it is. We're getting closer to saying that. As we did not gain nearly as many jobs as we thought. About 800,000 jobs less than was originally reported by the BLS previously. That's basically through kind of March of 23 through April of 24.
Okay. Well,
we knew things were slowing down, but they slowed down much more than we had thought.
So if listeners and audiences of the Gray Report may remember a few weeks ago in early August, actually, you don't even need to be a follower of the Gray Report to remember the stock market volatility that we had in early August. And a lot of people were saying it was the Japanese carry trade. Well, we talked about it, and it was shortly after that time, and we tossed the idea around, maybe it's carry trade, maybe it is the jobs report, because that was also in the in the zeitgeist of the time. And it almost
it came out around the same day. It was a weak jobs report, and that carry trade
and then
kind of news started on.
So I said, like, I was more worried about the jobs, and then I learned later that maybe it was the carry trade, but I still, whether or not the specific stock market moves or not, economically, I remained worried more about jobs than about Japanese interest rates ticking up, a little bit or not. That's like the baseline. However, looking
one more technical, and I'd say one more fundamental.
Yeah, exactly. And I also think that looking at the long-term trends of employment and unemployment, the way that jobs gains are typically measured, and comparing it to history. For unemployment, it's scary. But if you're looking at actually job growth, year-over-year job growth is trending towards like a 20-year median. Like the last 20 years, that's kind of where it plateaus around. So there is a question of, is it going to plateau like this and go flat, or is it going to continue to go gradually down? And actually, this is
I think, and that's the concern, right? Is that I think if it stays where it is, it's like that's fine. You know, this is definitely kind of average levels, even below average levels. Let's maintain it. It's the concern that we'll see further job declines, and that we're in a very tight we're seeing very tight monetary policy. It's very restrictive, and that could lead to fewer jobs. As that was the intention, getting the labor market under control, which good job. Looks like it's relatively under control. No one's talking about kind of a wage price spiral anymore. And so in terms of getting inflation under control, this is relatively good news, confirmation that it's been working through the system.
I do wonder, like, in terms of the psychological impact or the ability to kind of grab people's attention. When those numbers come out, it's a thing, but then the revisions, it's a little less impact. However, it was covered. It was a pretty big point on,
and they had been making
places.
Revisions like every month. They've been revising down, so it wasn't a shock to the system. I'd say. But okay, how does this jobs report or these revisions affect the multifamily industry?
I think that it's worrying because a recession affects everyone, and a downturn, and we have
can't pay rent if you don't have a job.
We have been experiencing the negative effects of high interest rates for a long time, and I know it seems like a totalizing view to view everything through high interest rates, but it does seem like things have gotten more expensive for buyers. There's slow activity. Of course, there would be worse job numbers. The same things that prevent a multifamily business to operate are roughly similar when you're talking about financing and keeping your business running for the greater economy. So loans large and small just aren't happening. We talked last week about how home buyers are staying. They're staying in their house just like multifamily buyers and sellers just aren't activating. I would say there is a silver lining for multifamily specifically in that the housing demand situation is so big. It is it's catching the attention of presidential candidates, and it's going to outlast any short-term recession. So the upshot for multifamily is, as we have seen in the past recession. Now, every recession is different, but as we've seen in the past recession, multifamily demand powered through that recession, and housing demand in general was not hit. So if this is going to be the same, maybe that's great.
Yeah,
a recession's bad for everyone,
and
that's
It's typical that you'd see some rent declines during a recession.
Yeah.
Then a very usually a fast recovery after the fact.
Yeah, multifamily would not benefit from a recession.
Yeah, exactly. That's where, some people say, oh, multifamily is, recession resistant. And it's like, no, it's not resistant. It's resilient. It can get through. Doesn't mean you can overpay and over leverage and make bad decisions. It's that if you're a relatively smart operator and you are buying right, you are not going to see a lot of growth during that period.
Yeah.
But you can easily hang on and then grow after the fact. And it gets through relatively unscathed. Again, if you're a decent operator and you're not overextending yourself. So
yeah, I did want to go through, because I did make these charts and I forgot to show them while I was talking about them. Just an example of two ways of looking at this. I did mention, like, is now different than before. So right now, looking at all employees, total non-farm, you see that from the period of basically the year a little before the year 2000 to now, the job growth is it plateaus at around 2.6-ish, and that's the number that we are heading towards right now. And the decline in the job growth is getting steadier and steadier, but it's continuing to decline. That's bad news, but it's not horrible. That's the silver lining, and I completely admit a silver lining, saying I've been saying I'm worried about jobs, and I think that is it will still be a negative signal to the Fed to cut rates. So also moving to unemployment, that's a little bit of a scarier graph. And the unemployment, it doesn't seem to plateau in the same way that the regular year-over-year growth in jobs does. It's always either going up quickly or going down gradually. The thing is, though, we've just gotten past a time where it went down quickly. Does that mean it's going to go up slowly? So, it's like this reverse roller coaster. Usually, the steeps are on the way up and the graduals on the way down. But now we just had a steep drop. So does it mean we are in kind of an unprecedented cycle?
Yeah, that's what's so hard for economists right now, is that the pandemic just throws all the numbers off.
Yeah.
And we've talked about time compression, and it's hard to look at the same time scales the same. But if you had to, just kind of take the craziness out, and then you were just looking for a recession, you would look and say, Matt, every time there's a little bit of a tick up, there's a recession, which makes sense. Okay, unemployment's rising. That would. There's
a brief part, maybe in like 2003, where it seems like, it went up without spiking
up a little bit.
Without spiking up totally.
Maybe here in the late 70s. I mean, there's a couple points where it's up and down, a little volatile here and there.
But you have to pick and choose those.
But you really have to, it's like sort of here. There's not really a case of where unemployment really moves up and then a recession doesn't occur. But now we haven't spiked in unemployment. To your point, Matt, we're really kind of just, kind of normalizing, because, we're at the 4.3%, which is up from, kind of bottom, kind of 3.4 era, but 3.4 is nowhere to be seen in the last, 50 years or so. We have to go back to 1969 till we see that kind of low unemployment rate. It's hard to tell, and it's hard to. Again, we looked at the yield curve last week as well. That there's a lot of technical ways where one can point to us having a recession. The fundamentals don't really point to a recession. We're going to have to keep watching the fundamentals. We've said in previous episodes, Matt, it's all going to be about employment. And the Federal Reserve probably isn't going to move until they see employment move. And now that employment is moving, the Fed is looking like they're going to be moving. So it's definitely, we have to keep watching it. But the economy in many other areas is, going surprisingly strong, and it is showing a lot of resilience for a variety of reasons. So it's uncharted waters. I guess you got to subscribe to the Gray Report.
That's right.